Welcome to the fifth module of financial management as we've been working through understanding the very important concepts and principles in financial management. Today we'll be dealing with capital capital budgeting as it pertains to financial management. And budgeting evaluates the long-term investment to maximize shareholders' wealth, and it involves planning future cash inflow and outflow for projects like new plants or machineries. So in the process, decisions are often irreversible and require careful analysis to avoid harming profitability. In the process whereby there is a need for investment in the future in maybe the likes of new plants or machineries, there are decisions to be made in order to look in depthly into if the project will be profitable or not, so that every necessary decision, every necessary things will be done to indeed have a profit on the investment that is to be done. And that is what capital budgeting is all about. And in the module, we'll go deeply into understanding investment appraisal techniques. We have techniques that can be used in doing an investment appraisal on the projects to be done, to be embarked upon. And this we'll be talking about the payback period, the net present value, and the internal rate of return, and lastly, the profitability index. We will also look into cash flow estimation, which focuses on identifying and forecasting the relevant cash flow associated with a um, with a project, including the likes of the initial outlay, the operating inflow, and then the terminal value. And lastly, we will look into the risk analysis in capital management, capital budgeting. And this addresses how to incorporate and manage uncertainties in projects evaluation through the likes of sensitivity analysis, scenario analysis, and other risk analysis assessment tools. So these are the things that will be done in this module. And as an overview, I talked about investment appraisal having a number of techniques. And for this study, I said we'll be looking into four. The payback period is the amount of time it takes for an investment to generate cash flow sufficient to recover its initial cost. So if there is a particular initial cost that is to be invested upon a project, how much time will it take for the project, for the initial cost to be recouped back, and then before it begins to result in profit for the investor. The next is net present value, and this provides the difference between the present value of inflow and outflow. It evaluates how much value an investment or project adds to the firm and consider the time value of money. It considers the time value of money. We have the internal rate of return. It is the discount rate that makes that the net present value of an investment equal to zero. That is, IRR is the break-even cost of capital, and at which the present value of future cash inflow equals the initial investment. We'll look at it practically, and we have a number of calculations here. And lastly, the profitability index, which is also called the benefit cost ratio, is the ratio of the present value of future cash flow to the initial investment. It shows how much value a project generates per unit of currency invested rather. We will take it one after the other. Payback period, just like I said, it is the time it takes to recover initial cost, and this can be calculated in two ways. We have a constant or even annual cash flow and then we have the uneven cash flow. For the constant or even annual cash flow, in order to calculate this, we have the initial investment divided by the annual cash flow. For example, if a company invests 600,000 naira in a new machine um, that generates 150,000 per year, you see that's the difference. It's a constant, it has a constant cash flow of 150 per year. How do we calculate the payback period? And you can see that we just take the initial investment, which is 600,000 divided by 150. We got a 4 year, so it means that it will take 4 years to recover the cost of the machine. Why we talk about the uneven annual cash flow? So as against the first one, this is when the annual cash flow inflow are not the same, just like the even annual cash flow. So for example, we have that of Patrick, who invested 500,000 in a new machine, and it's generated 100,000 for the first year, 150,000, 200,000 and 300,000 for second and third to fourth year, so respectively, in cash inflow. So to calculate the payback period, since we have 500,000 as the investment, so we will have to uh, the year three of the cumulative value of the year three is 450,000. That is, if you had 100,000 plus 150, that's 250,000. And also we have the 200,000, which is, we make it 450,000. So deducting 450 from 500, we still have 50,000 naira. So that additional 50,000 naira, which is on the fourth year, is needed to be calculated to get the actual year for you. So we already know that we have 3 years on ground. So the 50,000 naira divided by the 300,000, which is for the fourth year, gives us 3 years and 3.17 years that will take for the money to be recouped back on the investment. You have the net present value, and just like I said, it is the present value of inflow minus outflow. And a positive NPV means there is a value added. To calculate it, we have the formula there, why the meaning of those formula are also there. So for example, if we have a firm considers investing 800,000 in a project, expected to generate 300,000 naira annually for 4 years. The firm discount rate is 10%. Using the formula, we have it as stated there, which is CT cash inflow at that time, which is 300,000 naira for every of the years. We have 1 plus R. R signifies the discount rate, and 10% is 0.10, and that's why we have it there. And for 4 years, signifying 4 years, and minus the initial investment, which is 800,000 naira. So the final figure we got there was 153,446, which is a positive NPV. And just like I said, it is a value added stuff. And for NPV to be, the decision rule for NPV to be greater than 0, you accept the project. If it is less than 0, you reject the project. And if it is 0, if it is equals to 0, you it's an indifferent one, and it's not always common as such. So since NPV is positive, the project adds value and should be accepted. The internal rate of return is another one, and just like we've said, it is the discount rate where NPV is equal to 0, showing break-even return. And the decision rule is accept if IRR is greater than cost of capital, or reject if it is less than cost of capital. For example, a firm is considering investing 500,000 in a project that generates 180,000 naira annually for 4 years. To calculate the high IRR, it is here. The first step we have to do is to use the IRR formula, which we have done here. And because this equation is complex to solve algebraically, we use the try and error or interpret. So we try the two rates and we look at the first, the another step, which is try 10% discount rate. So at this point, we said that we um, we have a 500,000 investment and it generates 180. So we place the 180 there and then a 500,000, just like you see. For this 10% rate, we have a positive 70,577 naira 16 kobo. And note when it shows a positive NPV, you have to try a higher rate. So because it's showing a positive NPV, we have to get the negative NPV. So to do that, you have to increase your discount rate. We try at 20%. So if you are not sure of it, you can actually increase the value more than 20%, but we are using 20%. And when we use 20%, we are able to have a negative 33,025 naira 51 kobo on it. And the main formula for calculating the IRR is shown on the screen here. And we have the R1 to be the 10%, the second rate to be 20%, and we have the values there. In computing, we see that the high IRR is 16.82%, 16.82%. And if we will interpret that, it's if the company's cost of capital is less than 16.82, the project is financially viable because it earns more than its cost of capital. So if the cost of capital is less than 16, maybe we have the 10%, we have the 5%, then it is viable and can move on because it earns more than its cost to finance. We have the profitability index, which is the ratio of the present value of future cash inflow to the initial investment. And when P high is greater than 1, it means that it is viable. From this place, we can see the formula and assume a project requires an initial investment of 400,000 and generates the following cash flow, which over the 3 years, now we have 180 for the first year, 180,000, 150,000 for second year, 130,000 for third year. How do we calculate the profitability index? And we have it as such on this slide. And the PV, we will have to firstly calculate the PV. We get the PV before we are able to get the profitability index because we have to get the present value of future cash flow and we have the initial investment. So the PV results in 385,209 naira. In calculating the profitability index, we have a 0.96. And when we talked about the decision, we will say PI greater than 1 should be accepted because it is profitable. Now, since this is not up to 1 or above 1, it should not be accepted, it should be rejected. But now, if we want to see the other side of it, and we have, instead of the 400,000 naira as an initial investment, and 460,000 naira was used instead, was shown as an inflow instead. So rather, if the PV were to be 460,000 naira instead of the 385,209 naira, we will have a profitability index of 1.15, which shows that the project should be accepted. For cash flow estimates, we talk about, when we make into introduction, we said we'll be talking about 3 main things. The first one is the initial outlay, and this is the total amount of money required to start a project, including asset, installation, and working capital. The second is the operating cash flow, which is the net annual cash flow that the project is expected to generate throughout its useful life, minus expenses adjusted for taxes and depreciation. And we also have the terminal cash flow, and which is the final year inflow received at the end of the project's life, including salvage value and recovery of working per capita. These are the cash flow estimations that we have in your notes. In the notes provided, you have the calculations there, and you can go through for better understanding. And lastly, we are talking on the risk analysis in capital budget, and we've explained the risk analysis in the module, in previous module. And for capital budgeting, what are the sources of risk? We have market risk, project-specified risk, competitive risk, and regulatory risk, which affect the returns of a project. What are the risk methods that we have? We have the sensitivity method of analyzing risk. We have the scenario analysis, Monte Carlo simulation, and risk-adjusted discount rate. These are the risk methods that we have and how well they are also in the notes. The importance of this risk analysis in capital budget includes it helps to manage uncertainty, it improves decision, and also aligns project with risk tolerance. In conclusion, capital budget is very important aspect of financial management, which enables firms to evaluate long-term investment decision systematically. A way of mastering these concepts as discussed is very important as it equips financial managers to allocate resources efficiently, mitigate uncertainties, and drive sustainable growth in an ever-changing economic landscape. And this places in serious importance on this, and as a intended or potential manager of finance, it is very important for you to understand this. And thank you.